Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Let's congratulate Dan and his family for getting his son a house. That was an interesting first story, lots of twists and turns. But now,
whether I wanted to or not.
Exactly. Well, now we are going to talk about the stock market. We're talking about the S&P 500 bouncing around an important trend line at 4,800. I think it closed Friday right around 4,850.
4,300.
4,300. Sorry, 4,300. And we may see that break with a race down to 3,700. That's a lot of numbers I just said. Dan, why don't you educate us on what we are really looking at?
Absolutely. First, I'll share my screen and I'll show my newsletter information if anybody wants to just send me a note. If they want to join, it's free. It's just something I do every weekend for myself and share the information with other folks. So breakpointtrading@gmail.com is the email. Just send me a note and I'll add you to the distribution list. This is kind of a sample and excerpt from this weekend's newsletter. I'm going to actually talk about this chart you see right here. And I put a couple of cartoons in, like the groundhog.
I love your cartoons. Those most weekends, those make me chuckle when I get them. I like laugh out loud on the couch. Olivia's like, "What'd you get?" "Oh, another Dan email." Yep.
Yeah, I'm convinced that half the people on my mailing list just want to see the cartoons.
That's funny. That's funny. Okay.
All right, so let's jump over here to the chart that you just saw. And I want to talk about this, and we'll kind of progress from a high level view to a more narrow view.
Yeah, so people just realize this is the S&P 500 all the way back to like 2004-ish.
2004, yeah, it's about 18 years.
Okay.
Couple of things to point out. First of all, we right now are in a secular bull market.
Okay. Define secular and whatever the other one is.
Yeah, that's a really good question, because I actually had somebody from your sessions that called me with that exact question.
Awesome.
And what I suggested to them, and I'm going to show right here for everybody, is investopedia.com.
Okay.
So I'll just type in secular bull market. And this is, I'm going to put this in my newsletter next weekend because it's good information.
Okay.
So this is what is a bull market? What is secular? Actually, it's not where I want it to be, but secular market definition. So secular definition is a market that is driven by forces that could be in place for many years, causing the price of a particular investment or asset class to rise or fall over a long period.
Gotcha.
The secular bull market, positive conditions show as low interest rates and strong corporate earnings push stock prices higher. Secular bear market, where flagging corporate earnings or stagnation in the economy leads to weak investor sentiment. Stocks experience selling pressure over an extended period of time.
So I got to ask you, doesn't it feel like we're starting a secular bear market given that definition?
Oh, that's a good question.
Uh-oh.
And
am I leading the witness?
My response to that is, I think a lot of people will feel that way.
Okay.
But I think that is not the case.
Interesting. So we disagree, but you are the chart guy. So, okay. All right. Tell me.
And I talked about this in fact, I think I actually have it, the one that we talked about in our very first session right here. See this chart?
I do remember this chart. Yes.
All right. This goes back to 1920 to the 1920s. This is a 100-year chart.
Gotcha.
All right. So you can see the secular bear markets here in red. The market just goes sideways. And then we break out and we get into a secular bull market.
Sure.
That's where, like it said, over a long period of time, conditions are right and earnings are good, and the market just continues to rise. Then we go into another secular bear. This is the 70s when we had very high inflation.
Yeah.
We broke out of that in 82, right here. The secular bull ran until the 2000 dot-com crash.
Got it.
That was the end of that 18-year secular bull market.
Okay.
From 82 to 2000. Then we went into another secular bear, and this one lasted 13 years, from 2000 until 2013. Now you might say, well, what about this section? you
Yeah,
know,
we never
stocks ran
broke.
up really nicely right there. They did, but they never broke out. at this
Yeah, they
high.
never broke out. Yeah.
And it came crashing down in 2008.
Yep.
Right. So it
Okay.
stayed within the same channel. That's a secular bear market.
Mm-hmm.
And we are right now when it broke out in 2013, and some people could begin the period from the lows of 2009.
Yeah, the trough.
But I like
Okay.
to wait for the breakout because it could go right back down and stay in this channel, right?
Makes sense. Okay.
So this is the beginning of the secular bull market, 2013. And if you look at these secular bulls, they last about 18 to 20 years. So if this one started in 2013, we have until 2030 to 2033.
Interesting.
So
Okay.
we are still in a secular bull market. Now, if you look at the secular bear, this period here to 2003 to 2008, when the market was just going up, yes, that is a bull market, but that is a cyclical bull market.
Got it.
Not secular.
So we could have a cyclical bear inside your bull market.
That's exactly where we are right now.
Ah, okay.
That's where I believe we are.
Okay.
Right
so would it be fair to say we're starting a cyclical bear? Does that feel right that we're starting, or
yes,
at least
that's exactly what I've been saying.
Okay, cool.
All
right.
We are in a cyclical bear market, which is a bear market inside of the secular bull market.
All right, I can see that. All right, I get that.
Now,
all right.
If you look at this 13-year line right here, this is that period of 2000 to 2013, right? So this is the 2008 high that never broke out of this line.
Yep.
Went back down, came back up 2013, and finally broke out.
Okay.
If you draw a line across the lows, going all the way back to the beginning of this in 2009, you can see it very clearly, other than the COVID crash, very clearly respects that bullish trend.
Got it. Okay.
All right. That is a secular bull market. For this secular bull market to break and turn into a secular bear market,
got it.
We have to come all the way down here,
which is like 2,900,
3,000, right around 3,000.
Okay, 3,000. All right.
So we are in a secular bull until we break through 3,000.
Got it. Okay. All right.
However, we are beginning a cyclical bear market.
And then that's where your Fibonacci's come in to figure out where the floor could be.
Right. So this red line right here is 4,300.
Okay.
And I'll show you why that's important in a minute.
Okay.
But these are the Fibonacci levels.
Yeah.
For those that know who Fibonacci was. And
right.
Fibonacci numbers are found in nature and all kinds of things.
Yeah.
Everything around us has Fibonacci numbers in it.
Okay.
What I did was I used the peak, which is 4818 up here.
Yep.
Which was back in December or January, beginning of January.
And
I used this secular bull market trend line as the bottom.
Got it.
All right.
Right. And then you mapped
right below 3,000.
All right.
And what that then tells me is that the three key levels for Fibonacci is 38.2, which is at 4,100.
Okay.
The next one is at 50%, which is 3884. Okay. The definition of a bear market is a 20% decline from the high. 20% decline from 4818 is about 3850. So we will have an official bear market when we get to 3850.
Okay.
Even though all this, what's been happening feels painful, really hasn't even started yet.
Got it.
And then 61.8 is also an important level as well, and that's at 3664. So that's why I've been saying that we are headed for somewhere in this 37 to 3800 area.
Okay.
Right in here.
So let me just keep playing this out based on our, again, folks, Dan has a playlist that we've been playing with. So again, you can go back and watch the videos. So if I'm reading this right, based on what you've been teaching me as I learn this language, you're staying predominantly in cash. Yep. Any trades you do will be very, very short term, meaning days.
Right.
Playing very key levels.
Yep.
Do I have that right?
That's correct.
Okay.
I did buy a couple of things this past week. They're both oil stocks.
Ah, interesting. Okay.
Expecting the Russia-Ukraine invasion.
Yeah, something I thought on Friday was interesting. The bond market clearly sent a signal that they thought something would happen over the weekend, right? Rates went down, prices went up.
Well, the Olympics ends tonight.
Yeah, it's over already. Yep.
The market is closed tomorrow.
Correct.
So tomorrow is a perfect time. The other thing too is my brother is a big military guy.
Okay.
He's written a couple of books and on World War II. And he said that in studying Russia, he said that if Russia is going to invade, they have to do it in February. So many countries have made the mistake of trying to invade Russia in the spring. In the spring, the grounds thaw, it becomes a mud pit. You can't move equipment, everything gets stuck. That it has to be done while the ground is frozen. So he thinks it has to be done in February if they're going to do it at all. If they wait, if they wait even to the second week of March, then they're going to probably call the whole thing off and wait till next year.
Interesting. Wow, just little subtle things you don't even think about. That makes sense, right? They're moving all these tanks and all of that. You don't want to get your tanks stuck. They're really easy targets when they're not moving.
That's right. Exactly. So they're going to, if they're going to do it, they have to do it within the next week or two.
Well, let's hope they don't do it. Yeah.
I think they're going to do it.
Yeah, well, those are different decisions. I think they're going to do it as well, but I also still hope they don't do it. So both of those can be true.
Yeah, we'll look at something else here, which I just thought about. So
okay,
it'll be ad hoc, but at any rate, this is the long-term 18-year view of what the S&P looks like in the market. This hopefully helps you understand what a secular bull market means. And you can see that there were two cyclical bear markets inside of this secular bull. One in 2018.
Q4
and one during the COVID crash. Right. So let's go to this next chart right here. This chart helps you understand sentiment. Sentiment does not change quickly. The sentiment in the market takes time to change. And the reason for that is big institutions cannot get out of positions quickly. It takes them weeks or months to get out of a position or to get into a position. So it will be a long process. What this chart here is showing you is the put call ratio. This one at the top, this blue line. So it's a ratio of the puts, which are people betting the market's going down, versus calls, which are people betting the market is going up. When there are more puts than calls, meaning there are more people betting the market's going to go down, then this line goes up.
Got it.
Right? More puts means down.
Got it.
When there are more calls, that means everyone is betting the market is going up. They're not selling any longer, they're buying. So they're buying calls, and this put call line then will go down. Okay, make sense?
Yep, makes sense.
So if you look at this back to 2004, which is the beginning of the put call ratio back here, there's a very clear trend line at the bottom. The first one hit down here when, remember, when it goes down, everyone's buying. So everyone's buying here until, interestingly, the middle of 2006. Well before that 2008 crash.
Interesting.
And then people started buying puts. So the big institutions, remember, it takes them weeks to months to get out of positions.
Yeah.
When they see something happening in the market, they're not going to put it on CNBC until they are done selling.
Exactly.
And when they're done selling, then they'll put it on CNBC. So all of us retail traders can then say, oh my God, it's being manipulated.
Yeah.
So you can see right there, 2006 was the first sign. You probably had to wait about 6 months to make sure it was going up, right? But by the beginning of 2007, it was pretty clear that the buying was over.
Got it.
Well before the crash. The crash was here in 2008, right? Then it got all the way up here and it started to go down again. Remember, when it goes down, people are buying. So this is, you can see where it is. It's just before the bottom. So this is sentiment. This is market sentiment. It gives you a clue to what the big institutions are doing. because they're not going to tell you.
Okay.
All right. So you can see right here, this green line is just before the 2009 bottom.
Got it.
All right. And then we started going up, and you can see this is going down. So everybody's buying, buying, buying until sometime in 2011. And then it started to go back up again. We had a little bit of a correction right there. Went back up, buying, 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 back down here, 2014, middle of 14.
Interesting.
And then it went up, the market sort of went sideways through here, through this period. And then it started going down again. And then we get to 2018. 2018. So remember, back here in the middle of 2016, and you probably had to wait a few months to confirm that it was heading down. So by the beginning of 2017, it should have been pretty clear to you that the big institutions were getting out.
Okay.
This is well before the crash in 2018, not a crash, but the correction in 2018.
Okay.
Based on the trade war. Remember the trade war?
I do. Yep.
When the market went down?
I do.
Big institutions were getting out well in advance of that. All right.
Okay.
And they got back in here. They started buying again in 2019. They started selling again in the beginning of 2020.
Yep.
Right. And see this red line where they started selling. So they started to go back up. So they were buying puts again. This red line you can see is right at the peak just before the COVID crash. See it?
I do. Yeah.
All right. So again, this helps you understand sentiment of big institutions, what they're doing. Now, look what's happened since COVID.
Don't bet against the Fed.
Remember, when this line goes down, everyone's buying.
Yeah. That's
buying.
The Fed put on steroids.
That's right. The buying, it breaks through this 20-year. This is the 20-year support line right here.
Crushed it.
Breaks straight through it. This whole thing goes straight down.
Yeah.
Right. And you can see the market just went straight up until we got here. This is about the summertime. And then people started buying puts again. Even though the market was going up, you can see a little blip right here. Market went down a little bit and then came back up to here, but it didn't hit the low that it was at before, and now it started back up again.
Interesting.
Remember, when it goes up, that means everyone's selling.
Yeah.
Right. That's why it's a red arrow. So when this goes up, people are selling. Now look where this red line is. This is well before the high. This is sometime in November is when this put call ratio started to go back up again.
Yeah.
That was the warning signal. Remember what I said, sentiment takes time.
Yes.
Doesn't happen quickly. So we may have to get all the way back up here to this support line.
Yeah. Well, you've taught us in other interviews about reversion to the mean and all of this. This looks like a deviation move, so it may even have to go back higher.
That's right. It may have to go higher, which means the market has to go lower.
Exactly.
Right. Remember that 20% was at 38.50. And I was saying 37. I'm saying it could even go to 3,500. I think it will overshoot.
Yeah, of course. Yeah.
That.
Well, this again, anytime you have a non-standard deviation or a multi-deviate standard deviations, the give back is going to be equally powerful, right? Or
that's
could
right.
be.
It could be. Yep. So my point is, sentiment takes time. Doesn't happen quickly. We're not there yet. And I hear people saying, and I put this in LinkedIn. I put these charts in LinkedIn over the weekend. And I said, I hear people saying, when's the selling going to stop? When is the selling going to stop? I never heard when the market was going after the COVID crash from here all the way up to 4,800. I never heard people saying, when is the buying going to stop?
Yeah.
Right. Now they're saying, when is the selling going to stop? And when I'm hearing people saying, when is the selling going to stop? I think we might be close. It might be time to get back in. When I hear that, then I know we're not at the bottom.
Yeah, I didn't know where you were going, but that's my exact feeling. When people are still believing by the dip, we are not done with pain yet.
That's right. ETFD.
Yeah.
What I want to start hearing is, I am done with this market.
Yes.
It's
I'm
being
out.
manipulated.
Yeah. The
People are
little guy
taking-
can't win. Yeah.
Little guy can't win. People are taking my money. There's manipulation going on. I am done with this market. I'm selling everything. I'm getting out of it. I'm never going back to it again. And all I'm going to do now is buy real estate.
Yeah, I was that guy 20 years ago. I know exactly how that feels.
That's why I said that.
Smart man. Yeah, no,
All right,
we're nowhere
so-
close to that. That's funny.
So
Yeah.
we're not done yet. We are not
Oh,
done yet.
we're
So
not.
this chart here, this is a good example of the secular bear markets inside of a secular bull.
Oh, I like that. That
So
clears
here-
it up. Yeah.
Here's the secular bear in 2018, it was down 20%.
Mhm.
There was a little blip back here in 2015, but it was only down 15%.
Okay.
All right, 20% here, that's the definition of a bear market.
Mhm.
So that's a cyclical bear. This is the COVID crash, down 35%,
Yeah.
right?
Yep.
If we were to go 20% from the high right
Mhm.
now,
Mhm.
look where it puts us,
38 and change.
38.50,
Hmm.
right there.
Okay.
And we're all the way up here at 4,300.
Yeah, more pain ahead.
I think there's more pain ahead. The other thing you can look at is the VIX down here.
Got it.
Whenever the VIX gets much over 30, and then when it gets way over 30, then it's way overdone.
Yeah.
And that's when we're getting close to a bottom. But
Okay.
we're not even close right now.
Yeah.
We've got a long way to go before we're close to a bottom.
Very cool. Well, folks, this is going to be interesting. I love that little tidbit about invading in February, so your tanks don't get stuck in the mud. So
Yeah.
that was net new information. So that's cool.
Here's one last one,
Okay.
and now we're going, to a closer in view.
Yep.
And this is a little technical analysis.
Oh, the head and shoulder, yeah.
Education.
Yeah.
Education. This is a head and shoulders pattern.
Mhm.
So the market goes up, goes back down, hits a support line. Now this support line was initiated back here in
Mhm.
July. Went a little below 43, but came back up, came back down. Then it made a higher high, went higher up, and then started coming back down, came back and hit that support line or very close to it, 4,300. This also illustrates why 4,300 is so important.
Interesting.
And then went back up again, but it did not get back to the high that it was before.
Got it.
And then it starts coming back down. This is actually the reversion to the mean right there, by the way.
Hmm.
And then it starts coming back down, making what looks like a head, a left shoulder, and a right shoulder, with the neckline being right here at 4,300. And the way that these work is you can calculate the target by taking the distance from the neckline to the head, 4,800 to 4,300, that's 500 points.
Oh, then you reverse it.
Subtracting it from the neckline, 4,300 minus 500 is
3,800.
3,800.
There you go.
So here is our potential target.
So really all of this is you and your portfolio, your anticipation. You're thinking more pain ahead, and we may not see solid support until, I'll just call it 3,800 to pick a number.
Yeah, and by the way, we could go very fast.
Yeah.
4,100 is another support level.
Mhm.
So we could very quickly, maybe by the end of next week,
Oh, wow.
we could, if Russia invades,
Yeah, for sure.
we could very quickly get to 4,100, where it probably will bounce a little bit and then it will continue down again.
Hmm.
And the reason for that is because this neckline, everybody knows it. All the hedge funds know it. All the big institutions know it.
Yeah.
All the robots know it.
Yeah.
They all know that that is the level.
And then when that's
So what are they
breached-
doing?
Yeah.
They're putting their stops down here at 4,250.
Got it.
And they say, that includes the algorithms on the computers, the robots.
Mhm.
They're saying if it gets to 4,250, then I'm out. Start selling. And I think very quickly we're going to scream down to 4,100 from there.
Well, folks, this is why we do this every Sunday. We're going to see where we're at next week. Dan, one more time, if they want to get your newsletter, which I highly recommend, show us that one more time.
Yep.
Please.
There you go.
Yep. breakpointtrading@gmail.com. Get yourself added to the list. It is free. It's something I look at typically Sunday mornings. Dan, thank you very much.
You bet. Absolutely. Have a good weekend.
Thanks, buddy.